Hello, welcome everybody. Thank you for joining us today. If you would like to kick us off by sharing where in the world you are dialing in from in the chat, and what organization you are representing, that would be great. We're gonna wait just a moment to get going. All right, I think I will go ahead and kick us off, and then we'll get into the good stuff as people sign on. My name is Ani Patton-Power. I am the program director for the Impact Finance Innovations program here at Oxford Said. And I am very much looking forward to this conversation today. As I have said in the, please feel free to, in the chat, hopefully, it doesn't look like we can do chat. Maybe I'll just see if maybe I'm not sure if that's something that can be done on the fly. See if maybe our administrators can open up the chat to everyone. Otherwise, we will not be able to introduce ourselves in the chat. And so then I will ask that you put any questions that you have in the Q&A, but we'll just wait a minute to see maybe if we can open up the chat, the webinar chat. If not, welcome everyone. You can introduce yourselves. You can introduce yourselves in the Q&A if you'd like to. That can be something that we try out. So we'll see if we can get the chat open. But if not, we will still look forward to engaging with all of you in the Q&A. So really looking forward to this conversation today. I am going to very much step back and allow our experts to take this over. The Impact Finance Innovations program, which I run and I will talk about at the end, very much is concerned with issues like the one we're looking at today, which includes the racial wealth gap. And as I've said, in the promotional for this, as well as kind of in discussing it with my panelists here, is that there are things that impact investing has done well, and creating wealth at scale is not one of them. And so I think we need to be aware of that, and we need to be cognizant of that. But I think it's something that we need to be able to have conversations about how do we fix it. And that is this type of conversation. So Brian Boland's going to kick it off for us. He is the co-founder of the Delta Fund, and he's going to be talking also about unlock ownership, which is something that he set up. He's going to frame our conversation around why this is important. We are then going to have Kavya Shankar talk about trust neighborhoods and mints, which is, I think, a fascinating approach to thinking about ownership and home ownership and community ownership around real estate. And she's going to talk about the work that they've been doing. We're also going to have Todd Leverett talk about the work that they do at APIS and Heritage, which I think is fundamentally realigning how we think about ownership, and particularly really approaching this from a racial equity perspective. And I think that each of these participants, all of which I love to get to work with, have viewpoints that are really important within this discussion around how impact investing can really take on and do a better job of thinking not just about creating access to the ability to consume, but actually access to and enable and empower wealth creation. So I'm going to hand it over to Brian to talk a little bit about why asset ownership is important. Brian, I'll hand it to you.
Thank you, Ani. It's great to see everybody virtually, and good day. And I think everyone who's on the panel, I think Todd and Kavya and myself would echo how wonderful it is to get to work with you, Ani. It's a true joy, and we learn a lot from you. I'm Brian Boland. I'm from Delta Fund. It's a single family fund that's focused on investments and grants and policies that focus on improving human agency in historically underinvested communities. And a huge area of opportunity around that is around shared ownership. And so today we'll talk a little bit about why. How do we come to this conclusion that if we really care about human agency and improving measurably people's lives, that shared ownership works? And then really excited to have the opportunity to learn from Kavya and Todd, because they're building solutions that are real and are revolutionary And while some criticism that I have in the impact sector is impact for marketing's sake, both of these individuals are driving impact truly for impact's sake and high impact work. So why does this matter? A lot of this data is going to be US data, and we see that wealth inequality is accelerating in the US. There was an interesting buzzy moment earlier this year where there was some chatter that maybe the gap, the wealth gap had shrank for the first time in 20 years. It turns out that it's, like all data, a math question. And when you looked at what happened during the pandemic, there was an influx of stimulus that people got, and these checks showed up. Because the base of their wealth and assets was so low, when you actually took that as a multiple against the wealthiest, it looked like the gap had closed because the multiple of the wealthiest had decreased a little bit from where it was previously. The problem is when you look at the absolute gap actually grew. So while the math could be spun to say, hey, the gap is actually getting a little bit better, it's not. And so we have this persistent problem with wealth being out of reach for most people in America. And it's worse along racial lines. That data has existed for a long time and continues to persist. And we see those issues play out around the inability for people to really gain asset ownership through owning their home and participating in the properties in which they live, through having income and actually making enough of a living to be able to invest in the things that have made most other people a retirement living and the ability to have wealth accumulation. And some work that we do involves studies and market research on people and understanding where people are in this country. And one of the things that we do in that work is we actually ask them to bring in a photo that represents a topic. And so we'd say, oh, how do you feel about kind of your finances would be an example. And they're supposed to spend a week. If they see an image that captures how they feel about their finances, they'll bring it in. This is across the United States, across different geographies and backgrounds and political affiliations. And we saw this trend a few years ago that was really alarming, in that people started to bring in photos of water and stormy seas and drowning. And they weren't connected with each other. They had no way to know that they should be bringing in this drowning feeling, but that's what people were bringing in. And this reality that not only does the data say that there's this gap and that people are falling behind, but the reality is that they're feeling it, they're living it, and they do believe that they are financially drowning. So there is some good news, is that we're starting to understand the drivers of the wealth gap. And once we understand the drivers, we can build really compelling and interesting solutions to address that wealth gap. And you can look at 5 drivers that Bridgespan pulled out some data in a recent report. It's very interesting and worth reading. And these are 5 drivers that they're focused on how to align capital around. 2 drivers really stand out here. One is around income and benefits, and the second is around home ownership. And now it's important to kind of grasp the scale of these, that TN is in fact trillions, and that while these gaps have accumulated over time, the solutions can take a bunch of different forms. And that's why you'll see some of the solutions that Todd and Kavya are talking about really drive towards these categories of reclaiming these gaps in homeownership and reclaiming these gaps in income and benefits for people. And all this work represents the 2 largest drivers of the wealth gap. Really interesting report. So what we have the opportunity to do now is really make a shift in the way that capital is moving in the world and bring capital to these solutions that can fundamentally change the way that our society works, and that can alleviate people from feeling like they're drowning. The good news, on top of the good news, is that a lot of these solutions this isn't like crazy rocket science-y early stage stuff where you're like, gosh, I wonder if we have any proof points or any notions that this is going to work. These are a lot of proven strategies and early proof point strategies that we're seeing that are working. So this isn't just hey, we're in this super early entrepreneurial space where we have to take massive chances on things that won't work. These are things that work. They need the capital to be able to grow and scale. And so as we talk about these focuses, employee ownership is a huge lever for closing these gaps. And a lot of times when we think about employee ownership, we think about this first box, and that these people who were a part of stewards' shops eventually became millionaires because they were a part owner of the business, and that is possible. But the interesting thing about ownership is that because who owns matters, it changes how the economics work. So one of the biggest benefits of employee ownership is that you have profit participation. You have say over your work. You have say over your benefits. And so we see this lift in the income that people are making where policy has failed. And keep in mind that the minimum wage has been stagnant for decades in the United States. This solution actually changes that and drives more money into people's pockets and more benefits that matter to them because they're owners and they have a say over business. And it's a point in time right now where we have an opportunity, and this is a generational opportunity that's going to go away. This trend called the silver tsunami, where the baby boomers have come through the stage of their life where they're looking to retire, and they've started mid-sized businesses. They've started small businesses. And the way that you retire is you sell your business. And you have to sell it to somebody. The best place to sell it is probably to your employees for a whole host of reasons. So this generational opportunity is real, it's significant, and it's going to go away if we don't act on it in the next decade. Similarly, home ownership. When we think about home ownership, our concept of how home ownership works is you get a down payment, you buy a home, and that home appreciates. And that is true. And that is a major driver of historical wealth. But we need to remember that when we think about opportunities in home ownership, it's about benefits from the way where you live is owned. It's what happens if private equity owns your home. It's what happens if you're a renter and a for-profit company ruthlessly owns your home. The ways that we build solutions look at how homes are owned, how rental properties are owned, and the benefits communities receive from those properties. So the solution set is seeing a lot. This is a very vibrant ecosystem that is really starting to take very interesting looks at ways that we can change the power dynamic, change the way that money flows, and actually use where you live to change that outcome for people. Now, it's great that we have these solutions. We need the funds. And so we're running into funding challenges, right? So we've got these opportunities with these new models and the silver tsunami, and it's pressing and timely. We still see investors falling into the same kind of historical cycles and concerns that I think if they looked harder at the data would be less concerning around risk, looking at how they price the capital they're bringing to make these deals less affordable for the businesses and for the homeowners and the communities that want to do these types of investments. There's just not enough scale that's there today. And banks and CDFIs, despite CDFIs being incentivized to work in the space, are slow to move, and they haven't really caught on at the scale. They've done some. I don't want to say that they've done nothing. They've done some, but not to the scale that we need. We need to take a fresh look at how we think about capital investments, how we think about understanding risks, how we work around policies that exist at the federal level for SBA funding requiring personal guarantees and whatnot that can be closed by the private sector and the private markets. So while we believe that the policy levers are important and we're working on them, the capital sector, the private sector can do a whole heck of a lot here to move these efforts along. And so we're tackling a couple things to try to figure out how we can get more money to the funds that Kavya and funds that Todd are running. One of those is Unlock Ownership Fund, which we're happy to talk about if anyone wants to follow up. Think about the fact that we have hundreds of millions of dollars locked up in donor advised funds. They're invested in Coca-Cola. Now, I don't hate Coca-Cola, but I don't feel like Coca-Cola is particularly a mission-aligned investment for charitable dollars that we've seen receive tax subsidies around. So Unlock Ownership Fund creates a vehicle by which donors can now invest in all of these funds, and they can have exposure to these funds in a way that is easier than usually done for their DAF, if their DAF lets them do it at all. So this is the ability to bring donors together, combine donor capital, deploy it around these investments, and have real meaningful impact in this work. A second is some brand new work on the Ownership Capital Lab that Allison Lingain, who was a co-founder of Project Equity, is starting, designed to find new creative ways to bring funding into the sector. So what we do to create bonds, a lot of the risks of these kinds of investments are more bond style risk, and then we price them like venture, which is crazy. And so how do we start to build these structures that actually price things fairly and bring things to market in ways that are compelling? And the whole purpose of these first two buckets, the entire purpose of this DAF capital and these new forms of capital, is to create more money that can flow into the work that Kavya and Todd are doing, because we have to close this capital scale gap. that's kind of how we've looked at the problem and the opportunity. And when we think about that fact that when you ask, and I imagine Todd and Kavi will talk about the stories of the people who are impacted by their work, that feeling that I see in the market research we do of people feeling like they're drowning when their business transitions or when they're in a mint, they don't feel that way anymore. There's a fundamental change in their outcomes. And I'll turn over to them to tell you more about that.
Amazing. Thanks, Brian. Perfect framing for why this is important and where we're going. Kavya, over to you to talk about just neighborhoods and mint.
Thank you. Thank you, Brian, for that framing. So great to be with everyone. My name is Kavya Shankar. I'm one of the co-founders of Trust Neighborhoods. We're a nonprofit that works in neighborhoods at risk of gentrifying and helps that community own its own real estate. And I'll share a little bit more on where the idea of the Mixed Income Neighborhood Trust came from, how it works, and some of the neighborhoods in which we've already helped set up mints. So I'll just spend a moment framing our piece of the problem. Brian already provided a really good general overview of the dynamics that we're trying to tackle. Trust Neighborhoods, our organization is especially focused on a subset of neighborhoods across the country in the US, although you will see parallels in countries across the world. And we're really focused on neighborhoods that have been historically disinvested from due to US racist housing and financial policies that now are at risk of experiencing an appreciation in value, which is great, but at the same time, risk displacing renters who are located in those neighborhoods, just as those neighborhoods become higher opportunity. These are neighborhoods that are disproportionately Black, Indigenous, people of color neighborhoods. And these are neighborhoods where currently the population is majority renter. And so an increase in value shows up as rising rents and displaces renters from their homes. So we knew that we wanted to focus on that subset of neighborhoods and neighborhoods that have been historically lower value, that were in a moment of transition. And so Trust Neighborhoods started by interviewing neighborhood-based organizations across the country on their pain points. These are place-based organizations that were set up with the desire to really serve the local community. And we heard a number of pain points, but in particular, we heard 4 consistent pain points from neighborhood to neighborhood. We heard, 1, we don't have the capital to work at scale. One neighborhood organization spoke about writing grant application after grant application, securing funds to buy 7 homes, which 7 homes is still better than 0, but does not meet the scale of the need in that neighborhood for quality affordable housing. The second thing we heard is we don't have good accountable owners to replace bad actors. Consistently, we saw neighborhoods organizing against slumlords, against private equity owned housing, but that organizing just resulted in one bad owner selling to another bad owner. There weren't good owners in the neighborhood that could step in and actually purchase those properties. The third, what we heard is we need the flexibility to work within our neighborhood's typology. Every neighborhood looks different. Some are smaller multifamily properties, some are single family homes. Neighborhoods need the ability to work within the context of their community and needed tools to do so. And then finally, we heard we can't compete at the speed of the private market. Private investors were coming into neighborhoods that were heavily capitalized with outside capital, coming in to buy up properties, and neighborhoods were not able to compete with the speed at which they were purchasing properties. So all of that together is what led us to create the Mixed Income Neighborhood Trust, or MINT model. What is the Mixed Income Neighborhood Trust? The Mixed Income Neighborhood Trust is a model that allows a neighborhood to acquire, develop, and own a mixed income rental portfolio within the neighborhood. By focusing on neighborhoods that are going up in value, most of the portfolio stays at affordable rates permanently, and a minority go to market rate and help pay for keeping the rest of the portfolio affordable. And critically, the Mixed Income Neighborhood Trust uses a community-centric governance model, which, as Brian spoke about, a big part of the work here is about power and control, who actually has the ability to shape what happens with assets within the neighborhood. What exactly is a mint structurally? So a mint is technically two entities. It's a holding company, an LLC. That is what owns and operates the portfolio of rental housing. A mint is managed by a local neighborhood organization that's in that neighborhood, accountable to the community. That organization hires general contractors, property management in order to run a quality, affordable rental housing portfolio. That portfolio is controlled by a trust, which ensures the alignment of the mint with both community priorities as well as financial stability. And then any returns, financial returns generated by the portfolio are split between the neighborhood and investors, so that if a neighborhood appreciates significantly in value, it's not outside investors exclusively that are benefiting from that appreciation, but the community as well is building wealth and benefiting from the upside associated with the real estate investments. Mints are really focused on neighborhoods that are worried about displacement. We really focus on neighborhoods where there's a high capacity neighborhood organization on the ground with capacity and legitimacy, neighborhoods where there's an anticipated rising rents associated with living there, where there's the ability to really acquire at scale and help the neighborhood own at a meaningful scale, and where there's a pathway to securing the necessary impact capital to get the project started. Mints focus on three primary areas of impact. The first is changing power structures. Mints are focused on putting communities in the driver's seat, putting them into real positions of power through the operations and governance, so that they have a say over development that happens in their neighborhood, rather than at best being consulted on projects that other developers are working on. The second is increasing revitalization in neighborhoods. In Kansas City, the Mixed Income Neighborhood Trust there, 71% of the dollars that have been spent have gone towards fixing up homes, not just acquiring homes. Not only does this create quality homes for people to live in, it also improves the value of homeowners in the neighborhood. These are neighborhoods where most of the homeowners are Black and brown, and the dilapidated house or apartment building across the street getting renovated and fixed up increases the property value for that homeowner as well. And the third is reducing displacement. This model, first and foremost, focuses on renters, but it doesn't stop there. The reason it starts by focusing on renters is renters are the most vulnerable to getting priced out of their neighborhoods as their neighborhoods become higher opportunity. These are often families that need a break on their rent in order to save up to be able to transition into homeownership and use other programs like down payment assistance programs. This ensures they're able to continue to live in their neighborhoods, close to their families, close to their social networks, close to their culturally competent grocery stores or place of worship, and continue to benefit from that neighborhood as it becomes a higher opportunity neighborhood. Overall, combined across these three aspects, the goal is to really help residents stay in place, benefit from being part of a mixed income neighborhood that delivers better economic, social, health opportunities for all. There are 4 mints that exist today across the United States, and spans really from Fresno, California to Boston, Massachusetts. The largest mixed income neighborhood trust to date is in East Boston. They're a partnership between a tenant organizing group and a community development corporation to acquire 36 buildings in the East Boston neighborhood, 114 units total, and buying out an owner who has acquired the units over 7 years, kicked out East Boston families, and moved in young professionals and students who can afford to pay a higher rent in the neighborhood. This is giving the neighborhood an opportunity to own those assets, to move back in East Boston families, alongside helping them prepare for homeownership or any other steps that they want to take. So with that, I'm gonna pause and turn it over to Ani to introduce Todd to talk through another solution.
Thanks, Kavya. I just love getting to see the growth of this over the year. I mean, it's beautiful, and the way that that you have all your whole team, not just you, obviously your whole team is really bringing this to life, I think is just exceptional. And I'm gonna hand it over to Todd for a very similar story on a very different actually topic. As Brian said, these two different paths towards real productive asset ownership around companies and around homeownership. So I'm gonna hand it over to Todd to talk about the APIS Heritage Fund. Over to you, Todd.
Thank you, Ani, and thank you everyone for allowing me to be here. Really excited to be on the call and excited to share with you our team over at APIS Heritage Capital Partners, what we believe to be the solution to some of the issues that Brian so eloquently introduced a little bit earlier. So I won't reiterate the importance of the strategies that we're talking about here today, but really try to zero in on the solution that we think is one of the most important and impactful, which is employee ownership. So excited to share with you all kind of our flagship fund, our first fund, Legacy Fund 1, which is what our team sees as our reimagining of entrepreneurship, our reimagining of capitalism, using the longstanding tools of broad-based employee ownership, and with a focus on those communities and on those workforces who we know need it the most, and those are our diverse communities and our diverse workforces. So, how do we do that? Or even before we do that, let me a little bit of background, kind of why now specifically for the employee ownership solution that Brian introduced a little bit earlier, where we're at a kind of a once in a lifetime or a once in a multi-generational time period, and many of you are familiar, have heard of the silver tsunami, where a tremendous amount of assets are changing hands generation to generation. By some estimates, almost $10 trillion worth of just business assets owned by essentially baby boomers will be changing hands as baby boomers retire and look for exit options for their businesses. What this presents is both a tremendous opportunity and a tremendous risk. On the risk side, there is the concern that we'll have increased consolidation of business assets as kind of the major players in the market today, traditional private equity or traditional corporates, see opportunities to buy businesses and start to consolidate even more. And on the opportunity side, there's a real opportunity through using tools such as employee ownership, through ESOPs, co-ops, employee ownership trusts, to bring these assets and their wealth creating potential into the hands of working class folks of all backgrounds and all nationalities. And that's really how we look at the solution. So what is Legacy Fund 1? What is APIS Heritage Capital Partners? Essentially, our fund is a debt fund, a mezzanine credit fund that looks to provide essentially debt to working class people and workforces and enable them to buy the businesses that they work at. So in essence, we go across on the front end, we looked a lot like a traditional private equity firm, which is very, very intentional. But we'll go into the market for businesses. We'll have conversations with brokers, bankers, and business owners who are looking to move commercial assets and sell them, either because the owner is looking to retire, or they may be ill, or nobody in their family wants to take over the business. And we'll bring in our mezzanine capital and we'll essentially finance the purchase of that business by the workforce. How we address the racial wealth gap in our work is that we look to invest in businesses that have really diverse workforces. So to date, we look for companies that have at least a third of their workforce being people of color, and we look for companies where at least half of the workforce is low or moderate income. So really addressing both the broader racial wealth, well, the racial wealth gap, but also the broader wealth gap at the same time. The tool that we use to invest in employee ownership and create the wealth building opportunities for workers is called the ESOP, the Employee Stock Ownership Plan. It is one of many types of employee ownership that can be utilized. But in the United States, the ESOP, the Employee Stock Ownership Plan, is one of the longer standing forms of employee ownership that has a lot of legislative support and a lot of legal background. It gives it a lot of heft. And it's one of the most common forms of employee ownership in the U.S. To date, there are between about 6,500 ESOPs in the U.S. They've been around, ESOPs generally have been around for about 50 years. And one of the really powerful things with ESOPs that not a lot of folks know is that ESOPs pay $0 or they're able to defer 100% of their corporate tax liability in a way that no other company in the United States types of companies are able to in the United States. And this is a tax benefit that was given to ESOPs 50 years ago at the exact same time that it was created with the other most well-known qualified retirement plan in the United States, which is the 401k. So we often reference the ESOP as the lesser known cousin of the 401k that has been creating wealth for working class people for almost 50 years. The other reason why we decided to use the ESOP as our investment model is that statistics show that ESOP companies actually are better businesses in a lot of ways. So as you see on the screen, the stats show that ESOP companies, that are also incorporate what's known as ownership culture. So ESOP companies that have ownership for the workers, but that also invest time, energy, and money into the worker education, worker training, governance practices that incorporate worker voice, and general worker voice on the operational floor, just create better businesses. So 8 to 11% higher revenue growth, increased profitability, and almost 80% gains in productivity across the board. In addition to that, ESOPs have been shown to be one of the most powerful wealth creation tools and job quality tools in the United States. Some research that was done by the National Center for Employee Ownership shows that looking at S-Corp ESOPs, which is the type of ESOP that our company invests in, workers nearing retirement in S-Corp ESOPs have a median account value across the board of about $147,000 and an additional almost $100,000 in wealth in non-ESOP plans when compared to their peers in non-ESOP companies, which have around between $20,000 and $25,000 on average in retirement accounts. When you zero in and look at these stats for workers of color, specifically the research looked at workers between age 28 and 34, workers of color in ESOP companies have a median household net worth that's about 80% higher than than non-employee owners. Median income that's about 30% higher than workers of color in non-employee owned companies, and median job tenure that's about 36% higher. So when we're talking about creating wealth for workers, when we're talking about creating better businesses, when we're talking about creating communities with jobs that are able to stay in place and high quality companies that stay in place, ESOPs are really, while not a silver bullet, they're a solution that is powerful. So how do we go about creating ESOPs for workers of color? First, we go and we look at what we consider real economy companies and essential workers. So our firm focuses on finding companies in the realms of landscaping, cleaning, nursing and elder care, waste hauling. And what we do is we look for companies that have at least 40 workers. Again, at least a third are people of color, and that companies that are doing well, that are growing. One thing that employee ownership in the past, when this kind of concept first started going, look to create employee ownership in businesses that were under distress. So looking for a buyer, We're facing tough economic times, and they look to create employee ownership for those businesses because there were real opportunities to move the companies. What we found out is that as they were, employee ownership doesn't make a business that doesn't work. It doesn't make a business that doesn't have a pricing model that works work. But what it can do is take businesses that are doing well, that do have powerful market positions, and that do have a product or service that the market demands, and help them grow faster and stay around longer. So we look for essential workers in essential industries and look to convert those businesses. What does this look like in practice? You see on the screen a comparison to what a traditional private equity transaction looks like and what Apis and Heritage ESOP or elbow transaction looks like. And you see in a traditional PE transaction, companies are loaded up with senior debt while the private equity sponsor holds on to a little bit of equity. And essentially what happens over time, the private equity sponsor is supposed to try to create value in the company and then eventually sell the company in year 5 and get pay off the debt and get a large equity return to refinance the debt. In the A&H transaction, essentially what we do is we bring in our A&H investment, we bring in a senior lender, and then we'll put our A&H note, which is a patient capital, patient debt on the company, as well as a seller's note. And then what we'll do is we'll use the cash flow that we get from the company, the cash flow that we get from the tax savings, to rapidly pay down the senior lender in the transaction. And then in year 5, what we'll do is look for another senior lender to come in and take out our A&H investment and leave the workers in a 100% employee-owned enterprise. We do not look to sell the company in year 5 because the risk is, as you can imagine, if you sell the company, it may not be employee-owned anymore. So we look to use the tools and the scale and the speed of M&A transactions, but we look to use the thoughtfulness, the patience, and the heart, so to speak, of employee ownership in the world of ESOPs and co-ops. I'll give one example of one of the companies that we invested in. One of our first investments was in a company called Accent Landscaping. You can see a picture here of some of the staff at Accent and the owner, Cameron Stevens. And when we made the investment in Accent back in 2022, they were a wonderful business, great market position as one of the leading commercial landscapers in El Paso, Texas, but they were really struggling to find workers. It was really their major pain point, and it was really holding them back in a number of ways. At the time we came in, the company had a lot of business in front of it, but they did not have one crew that was fully staffed. And the pressure on the whole team was really palpable and everybody could feel it. We came in May with the ESOP. We elevated the company's vice president, who had been there for about 40 years, named Joe Aguilar. He's the gentleman on the far left. Elevated him to the role of president of the company. And we started working with him, the CFO, the executive team, and the ESOP committee, which we set up to start addressing some of these issues. And one thing that we were able to do very early on, within the first couple months that we got there, is we were able to raise the base wage of the company up about 20%, which impacted about between 40 and 50% of the workforce were able to get their wage up about 20%. And then throughout the year, we did across the board raises or bonuses for everybody else on the workforce. By the end of 22 and by the middle of 23, we were able to get the company's first ever employee representative on the board of directors and the first ever independent director on the board of directors. 2.5 years later, we're happy to say that Accent Landscaping no longer has any hiring issues. They've been able to attack the pipeline of work that was behind them. They've been able to readjust their margins and grow steadily over the past several years. The workers have been able, to date, we've done worker announcements where we were able to share with the workers the value of their ESOP shares, and we'll be doing another one next month. We're happy to say that the worker rep on the board and the independent rep on the board are now functionally helping guide the company forward on behalf of all workers. And this is the type of impact and change that we look to do at all A&H companies. So I will stop right there because I think I'm going a little long and pass it back to Ani to open the conversation.
Amazing. I have to say, this is probably the first webinar I've done in many years where you were all exactly on time. I'd just like to say, well done. So thank you all very much for each of those perspectives. I think this is fascinating. And if you have a chance maybe to flip through some of the people that are actually on the webinar, some really interesting organizations and some community-based organizations and impact innovators. I'd just like to say it's fun. I'm sorry you're not all up on our screen on the call because there's this space is ripe for innovation, but also does have an incredible set of organizations working in it. And I think Todd and Kavya, you have both showed examples of tangible solutions that can work to help empower individuals, to help empower communities to be able to build wealth. And I just, again, thank you for that work that you're doing. So my first question for the three of you is, what have you seen be the biggest shift in the conversation in the past few years kind of around this topic of, really whether you're looking at kind of the racial wealth gap or just ownership from a racial equity perspective? What have you seen be the shifts in conversation that you're seeing to where we are now? I'm happy for anyone that would like to start.
I'll go ahead and get us kicked
Thanks,
off.
go ahead.
Specifically for the world of employee ownership, when we started this work, this specific fund 3 years ago, but I've been in this work for almost a decade. None of the solutions really use the word ownership, right? It was all, income. It was all, what can government legislation do, but actually talking about ownership, which I think is a hot button issue, because you can't look at ownership without also looking at how ownership came to be. And you start to look far back enough and you start to see all of the systemic issues and historical issues that have caused this massive imbalance in ownership that Brian talked about. So the fact that the word ownership is even part of the conversation, I think is huge. Specifically from an employee ownership standpoint, this concept, people thought it was something out of Communist Manifesto when we first started talking about worker ownership. And now what we're seeing years later is that there are a number of vehicles, financial vehicles that are out there talking about employee ownership. And then to date, you're starting seeing some of the largest investment firms in the world. You're watching KKR and Blackstone talk about using the words and using the terminology of employee ownership and employee equity. And I'd like to think that our team and all the other teams who've been doing this work for many, many years were part of shifting that dynamic of being able to talk about worker ownership in a finance perspective or a business perspective.
Super interesting, Todd. Yeah, Kavya.
Yeah, so I think that historically, wealth building has been really talked about on an individual level. So how can we help this individual, this family buy a home, get access to this investment product, really centering the individual. And I think that without also thinking about community power is limited. And I do think there's been a shift towards community ownership alongside individual wealth building, which I think is critical for putting in place systems that over time will advocate for and build wealth for entire communities of people beyond just tackling the problem on a person by person basis. So I'm very encouraged by models, not just ours, or a number that have popped up that have been really focused on how do we really shift ownership how do we think about the neighborhood scale, the community scale, and build power and wealth that way as well.
That's super fascinating. That is a different take really than the individual. That is really interesting, Kavya. Yeah, Brad.
I think when you're on to something, the big traditional guys are going to jump in there and they're going to give you some marketing speak and they're going to build something that claims that it's what it's not. And so I think Todd's right on the trend of the KKRs and others who are excitedly talking about employee ownership, but I think it's really important for investors to take the time to look at the outcomes that happen from these various funds and investments. The same thing's going to happen in the mint and community ownership space, is that some large PE firm's going to come along saying they do mints, and it's not going to be that. My view in the KKR model is it's a bonus program. Like it's a short-term incentive program that doesn't lead to real worker voice and lasting broad-based employee ownership. And if investors really want change, they should be working with Todd. They shouldn't be working with KKR, which will give them like a nice bump, but is using the words to kind of sell their product. A little harsh. That's what I believe. Is the bonus program better than like the current PE model? Yeah. Should we settle for marginally better for a system that's extracted for years? No. So like I think really, really leaning in and going for these funds that are bravely designing products that still return for investors, but are designed to return for communities and people is where people should really be excited about, and not just hearing the word employee ownership, getting excited and going with the traditional model.
Yeah, I mean, Brad, I agree with you, because I think even in some of the critique around kind of impact investing, we can substitute those words out, right? I mean, we now have $1 trillion of impact investing floating around, but the question is what is it really doing, and who is it really benefiting? And I think there's, by asking, Todd, to your point, by like talking about things like ownership, and Kavi actually thinking about like communities, and how is this capital resulting in changes? I think from my perspective, I started in impact investing back in the very early days when we were talking a lot about microfinance. And what we know about microfinance is that if people take out loans to do consumption, in the long term, it actually does not provide for better outcomes for them. If people take out loans to do investment, and that can be investment in education, investment, but essentially investment versus consumption, in the long run, people have better outcomes. So microfinance is not good nor bad, like many technologies. It is how it's used. And I think that's where the same thing with impact investing, we can do a lot of things at the margins by investing in things that create access to products and services that are super useful. But if we're continuing to only work at the margins, we're not going to create the type of systems change that I think both of your organizations are working for, that is about, who owns, what do power structures look like? How do we actually think about, is this shifting the system? And I think that's what's really important about the work that, both of you are doing and that Brian's doing as well, around really rethinking some of these systems, not just perpetuating old models.
I would add one more shift, which is I think we've gotten away from only looking at win-win opportunities. I'm really excited about, where I think, kind of to the points Brian and Ani you raised, I think impact investing very early on was, oh, we can deliver the same returns and we're also going to give you impact, which is a nice bonus, but the reality is you're leaving a lot of impact on the table. If investors are willing to still earn a return, but a slightly lower return, and give up some of that upside to enable deeper community impact. I think when I started off in this work, I didn't see a lot of investors at scale looking at more catalytic investments, and that's absolutely been a shift that I have observed. People who are willing to say, yeah, I won't be the gentrifier and buy up a bunch of buildings and rent them at market rate, even though that's a better return. Instead, I'll invest through a model that keeps most of the units affordable, and be willing to earn a lower return in order to enable deeper community impact.
It's spot on, Kavya, right? And this is the whole thing. I think we were nervous at the beginning of impact investing about talking about these trade-offs, right? Because that was the first thing that people talked about. It was like, oh, well, if you're going to do good, you're going to make less money. And people were like, no, we're not. And I think it's, the maturation of the space to say, yes, you can have some win-wins, but not everything's win-win. And so if we're going to find some of these models where we can find where more people do win, but potentially the investor does not, maximize their return. And so the question is around, what are you optimizing for, and what makes sense and a risk adjusted? And I think Brian brought that up in the sense of, everything being equity requiring equity returns, and not being equity risk. So there's a whole discussion to be had around matching risk and return. And I think that's just, that's a whole deep conversation that we need to have. My next question for the three of you is, what do you think are the biggest gaps in the market that, not necessarily on the ground level, what you all are doing, but, what are the gaps that you see that you would love people kind of on this call to be aware of and potentially be addressing? What are the areas that need action to be taken now? Go ahead, Todd.
Yeah, I'll again start specifically from the employee ownership space. I think that the obvious one, or it wasn't obvious before, but it's always capital, right?
Not always capital, but I do agree with
Well, in the context of M&A, right? So we're talking about doing M&A of businesses. It's typically capital, and so I'll step back. So our work, the 8% Heritage, started out of a national nonprofit called the Democracy at Work Institute. So I used to lead up a program called Legacy Business Initiatives, and their job was to go out and try to figure out how to scale this, right? How do you scale employee ownership for diverse owners, for diverse workers? And I'll tell you, across the board, everybody loves, once you kind of shake people's kind of mindset around the paradigms around what it means to be an owner and a worker. Everybody loves the concept, business owners, workers, government leaders. Across the board, everybody was really enthused. But then there was a question of why isn't there more of this? And the answer was at the end of the day, especially when you're dealing with small businesses, it takes if somebody's going to sell their business, they're going to need to, most of the time, they're going to need to have some sort of financial benefit that's comparable to other players in the market. So when we're doing business M&A, using employee ownership, capital was a big piece. The other thing, though, was just knowledge, right? I did an undergraduate business degree, graduate school business, law school, worked on Wall Street, and never heard about employee ownership as a real option for anything until I started working at a nonprofit in Detroit called Center for Community-Based Enterprise. So all those years, all that time in the business and legal world, and it wasn't brought to my attention. So I think the more people we can help understand this is a real option, in the professional world, in the business owner world, across the board, I think the light bulb will click on, and folks will come looking for the way to make this option a possibility.
Absolutely. Brian, Kavya, did you want to add anything there?
I think that the big piece is how to really organize large pools of capital when it comes to this work. And in particular, I'm really interested in how we think about better accessing the pension fund, insurance company, endowment set of funds. There's so much of that capital. Those portfolios are so large that to build a diversified portfolio can include a range of investment options when it comes to risk and return, and finding more opportunities to continue to access that type of capital for more deeply impactful models is a space that I think has started to gain some traction, but there's more opportunity to do more given the scale of capital.
Absolutely. Brad?
Yeah, I think two things that I think are particularly interesting is one is how do we get broader access to people being able to invest in these things. So right now, a lot of these are accredited investors only, and it'd be amazing to figure out how we open it to the broader communities that benefit from these efforts. Then second, I think just really getting people to get out of the mindset of either they're maximizing their financial returns or they're losing. Right. And Katie and I hate the concessionary term because you're actually getting a whole heck of a lot of productivity out of the capital that you're deploying. And so I think really trying to help people rethink and reframe and be excited about financial returns that lead to really interesting and really significant societal returns for people and planet, and not saying like, well, what's my benchmark against the markets that have only cared about the financial side, but rather looking at deals internally of saying like, hey, look, I'm making a few percentage points here on the financial side, but wow, look at this impact side of what we're getting with people and planet.
And that's just the point, right? Like, what are we trying to build? What are we trying to build? Are we trying to build, the wealth for a few, or, wealth for many? And I think that's where, the impact investing space has been in some ways obsessed with proving itself, as opposed to changing the way we allocate, the changing the way the system works. And that's fine because we've done that in certain degrees. And so the question is, what's next? I put a few links in the chat. Please feel free, everyone, to share other resources as well. There's, as Brian mentioned, the Ownership Capital Lab. Andrea Armini is here, who's now at NYU, but Transform Finance has an incredible report and has done a bunch of work on this. Impact Alpha has done a ton of work around employee ownership, including profiling both of ours, or two of ours, well, three of our speakers actually. So before we close off, I'm just going to quickly share my slide one last time, and then I'm going to ask a final question of our panelist. But here we go. So if you want to watch or listen to, watch or listen to more of our webinars, there's a QR code here. You can take a picture or do a screenshot. We also have 3 courses that we run at Oxford that touch on topics within impact investing and measurement. The Oxford Impact Finance Innovations course, which is in November, is the course that I run. And very much interested in the next frontier of impact investing. And we look at concepts such as employee ownership, community ownership, using emerging technologies to facilitate this, looking at structured exits, a variety of different fund and deal construction, to be able to kind of really push the edges of what does it mean to allocate impact capital. So you can take quick screenshot of that. The team, if I can ask the team to put a link to the application in the chat as well as I'm filing up, that would be great. You will get a follow-up email as well next week with this too. So I'm going to stop sharing here. There we go. Just to finish us off, and thank you. Oh, perfect. There's some more going in here. Great. Perfect. So just final 2 minutes. What's one thing you hope everyone takes away from today? We're going to start, Todd, with you again.
Yeah, I would love for whatever your interest in the impact world is, whether if you're a founder, if you're an investor, wherever you are, to really start measuring worker outcomes in a very real way. Making sure that understanding how your workers view the quality of their job, whether you're doing employee ownership or not. A lot of these tools that come from the co-op world, employee ownership world, can be applied across the board, but really starting to get their voice and also starting to look and say, hey, what is the wealth creation potential of this job that I'm supporting through this investment or this company that I'm running, and really bring a worker-centeredness back to the work that you're doing, again, whether it's ownership or not. Ownership is best, but if not that, just a worker-centeredness.
Love it. Kavya?
I would say take a risk, try something out, be action-oriented. I think that the best way to learn what works in this space is to try something out and learn from it, whether that be allocating capital or trying out an innovation. Put something into action and learn from it. And this space is stronger with more innovators who are trying to tackle these issues.
Brian?
These are solutions that have proof points and that have results and outcomes. They're not random speculative ideas. And most of your capital is probably playing a speculative role in the world today. And so you have an opportunity here to change what your capital does and to be productive and to be somebody who is a productive deployer of capital that is creating things in the world. I think that's the opportunity with these that I call people towards is be less speculative, more productive with the capital that you deploy.
Wonderful. Thank you all so much. We are at time. This is, as I expected, a fascinating conversation. I just want to thank you all for the work that you are doing and in making capital more productive, changing who owns the businesses, and really thinking about how communities interact with high opportunity areas, which I love that language, Katya. Thank you everyone for joining and all the work that all of you do as well in this space. Look forward to engaging with many of you in the coming weeks and months, and hope everyone has a great rest of their day, morning, afternoon, evening. Bye, everybody.